Well, hello, I'm Chris McAlpin, managing partner at Sound Financial. And wow, what a January. And it's not over yet at the recording of this. But it's a common thought. I've heard this all of my career, and we still hear it. I guarantee you're going to hear it this year as well. But there's a saying around the industry, and it goes something like this: as January goes, so goes the rest of the year. That's a scary thought. Wrapping up the end of January, and you're starting to go, "Oh wow, does that mean that we're going to put this kind of volatility all year long?" But I don't think so. Look, I looked up over the last 10 years, just ran a few charts, and in the last 10 years, 5 of the last 10 Januaries have finished the month negative. So this is not totally abnormal, okay? And as we look at a month kicking off like this, it gives us a good time to kind of sit back and reflect and say, how are my plans? Or am my investment accounts lined up in the right spot? Because we've had some of those classic market days that should really teach us something about ourselves, what kind of investor we are, what type is our accounts fitting within our plans. Let me give you an example, okay? January 24th was one of those days that just started off and it looked like a bloodletting. I mean, by lunch, the market was -3. And when I say the market in this case, I'm talking about the S&P 500. And when you looked at the Friday before, it had broken the 200-day moving average, and it just opens up, falling all over itself. And if you had looked at your model and you looked at the markets right then, and you said, "Oh my goodness, my model is not doing what it's supposed to do, and this is not the right model for me," and you panicked and you sold, you would have missed that market recovering throughout the rest of the afternoon and actually finishing the day positive in this crazy turnaround. And so it taught a few lessons. And we had some conversations around here regarding this, that look, when you get one of those days where the market's just falling all over itself, that is typically a terrible day to make a decision. It's a terrible day to look at the news and start to try to tinker with your financial plans. Now, we've got to do it because this is our line of work. We do it all the time. So we look at days like that and we go, okay, we got to kind of internalize this and roll with this and go on. But this is why we build models. This is why we have rules to follow. And this is why we have plans to fall back on. So in these emotional times, it's a great time. And I want to take this moment to say this about emotions, because we're going to talk about this a lot with behavioral finance, but follow me in this. Emotions are wonderful. They're wonderful for relationships. They're wonderful for inspiring great change and doing a lot of good in the world. And they're also wonderful to sit there with a good book and a cup of coffee and enjoy the moment. But emotions can be terrible when it comes to investing, okay? So I want you to take some days like we've had, talk with your advisor and learn something for it. But for the rest of this talk, let's look at the facts. And let's just look at the cold, hard facts of what are we dealing with this year. And so here we go. Here's some big facts that we have to deal with. Number one, inflation is a problem. And we're going to look at this probably at least until mid-year, and we should start to see it trail off into the end of the year. But is this inflation caused by the U.S. government flooding the U.S. economy with a ton of cash? Yes. That's one of the causes. Is this inflation caused by supply chain disruptions all over the world? Yes, that is one of the causes. The good news about those two being a cause is that there is an endpoint to them. That cash is going to level out in the economy, and it's going to smooth out and be okay. There will be a time that the economy of the world opens up and the supply chain starts to roll again, and it smooths out. It's just not going to happen overnight. But when we can look at an event and say, all right, there's an endpoint to it, okay, we now know how long we have to deal with it. Now, has more systemic inflation started to seep in? Well, I don't know, because that's where we just don't have a crystal ball. I cannot tell that. And this is what the Fed, I suspect, that they're watching very closely. So number two, you got inflation to deal with. Number two, what's up with the economy? We've had this robust, growing economy that was really statistically robust because it was coming out of that deep recession, that real sharp V-shaped recession of COVID-19. So as we come out of that, the pandemic and the quarantine winter and spring of 21, we had this explosive growth. So in the winter of spring of 22, there's no way that our economy is going to match that growth. So statistically, we're not going to keep up. So it means we have a slowing economy, but the economy is still growing. Okay, so there's a good news, bad news. But what this does between inflation and a slow growth economy is that it puts the Fed in a pickle. Because the way that you fight inflation is by lowering interest rates and shutting off the supply of money to the economy, letting the economy cool down on its own. That's how you fight inflation. And the way that you fight slow growth is you juice the economy by pumping money into it. So the Fed has a job to kind of do each one of these. And so if they get to live in a vacuum and work in a vacuum and only do what they want to do, then they get to kind of make a choice. But that's not real life, because we're also in a midterm election year. So there's going to be a lot of political pressure on them to kind of split the difference and solve both problems at once. That is going to be a challenge. And that are some of the facts that we're going to be watching. We're going to see what we suspect. Now, this next part, I'll get into a little bit of prediction space of what do we suspect that they may do. So right now, as January has kicked off, the stock market has tried to price in 4 rate increases by the Fed. And as you can tell, it hadn't liked it very much at all, okay? And so we suspect the Fed may come out and go, no, we're not going to raise 4 times, we're going to raise 2. Okay, so we're going to try to split the difference between fighting inflation and fighting and juicing a slow growth economy. We're going to kind of split the difference, but just raising it a little bit, just shutting off that money supply a little bit. And so it'll just kind of smooth out. Can they pull it off? I don't know. We'll see. But as I said earlier, we don't want to make decisions with emotions. We want to make them, based on the rules and based on your plans. And so this is a very good time for you to do a couple of things. First, make sure that you have discussed your financial plan with your advisor. I asked you that in the last update. Have you done that? So have you done that? Do that sometime this year. Do that sometime in the springtime. Do it soon if you feel the need to do it soon, because this is a financial planning question for you. Are you reaching your goals? Do you have plans to reach those goals? Let's come back to those goals, because in those emotional times, it gives us a foundation there, okay? Next, let's be disciplined to follow our rules, whether it's the rules in the financial planning or whether it's the rules in the investments. Let's not try to make knee-jerk reactions and try to front run the market and guess which way it's going or guess that I need to get out of the way. But the rules have been tested over long periods of time so that we have broad data sets to look at, not just 3 weeks of a year, which is the first 3 weeks of this year as we're having this conversation. So be disciplined, discuss your goals with your advisor. It is our job to serve you in you reaching those financial goals. So let's work together to do an excellent job. Take care. God bless.
For disclosure and citation information, please go to www.soundfsg.com/disclosures.